our thank you for joining our first webinar for the year. My name is Victoria Fabomi, and I lead the CcHUB Syndicate. CcHUB is Africa's foremost technology innovation center, and we are driven by our belief in innovating for better society and ensuring the application of social capital and technology to creating economic prosperity for the continent. Today, we'll be speaking about valuation, and our webinar is tagged How Much, right? A deconstruction of startup valuation in an age of Lush capital. If you have been following the startup ecosystem, we've been hearing a lot of numbers being thrown around, and perhaps there might be a bit of mystic air or even a mystery as to what's driving the numbers. We have three panelists who will be helping us deconstruct this information that has been bombarding us and allowing us to understand a bit of the VC space from an investing perspective and what's driving the numbers, all the numbers that we see in the media. So I'll start with the first panelist, Isaac. Isaac is an experienced finance professional who currently works at MSD Partners, a leading private investment firm where he has oversight over investment performance. Prior to that, he worked at Goldman Sachs and headed the investment banking controller team, and previously PricewaterhouseCoopers. He has a background in chemical engineering and mathematical finance from Rutgers University. Other panelist is Francis Sani. Francis is a startup growth architect with experience supporting growth of technology entrepreneurs and innovators across Africa. He has a background in management consulting and innovation engineering, and so he has supported 200 plus high growth startups with their fundraise, helping these startups create jobs and build value across varied communities. He currently works as a principal at Magic Fund. It's a $30 million fund with portfolio valuation of about 15 billion. And he also manages strategy for one of the largest health tech startups in Africa, Helium. The last panelist is a colleague. His name is Rofem. Yes, Rofem supports the team with portfolio and drives a lot of our research work. Prior to Rofem joining the CcHUB team, he worked as an investment banker focused on healthcare, financial services, and technology. So thank you for joining the panel today. Before we jump in, it would be great to hear, your voice. Hi, Isaac. Hi, Francis. How are you feeling about the session today?
Hi, Victoria. Thanks for having me, and thanks for putting together a session. I think that education is necessary, and you guys are doing a phenomenal job in the ecosystem, and I've been a beneficiary of all of your literacy efforts over the past years. So excited to be in the conversation today.
Thank you. We do appreciate it. Francis?
Excited to be here with all of my guys. I'm just a small fly on the wall who's going to cause trouble. Valuation is always an interesting topic. So my plan today is to cause trouble. So if you are here for violence, let's go. We're glad to be here.
Let's love Rofem.
I'm just excited to be able to have this conversation. It's one that we've been thinking around. It's one that we constantly have back and forth to the office about. So it's basically here the perspective of other investors in the ecosystem.
Great. So perhaps a bit of context setting before we go into the conversation in full. We've seen a lot of deals happen on the continent in the last couple of years, right? And to date, in terms of CAGR, Africa has the fastest in terms of number of deals. We've seen the deal volumes significantly increase over the last 5 years. And there's several growth drivers, right? I think some of that will seek to get understanding from our panelists, but just based on the numbers, we've seen a lot of inflow of capital into Africa. I know that there is still a bit of concentration with fintech taking most of it. There's still a bit of concentration with funding going to the hotbed. But every now and again, you'll hear people having conversations like, what's driving these numbers? What's behind these numbers? How in the world are African startups able to attract this kind of capital, and at what valuations are they attracting this kind of capital, especially with what's going on across the world from a global perspective? Isaac, we'll start this conversation with you. What are your thoughts generally, right? When it comes to valuation, I know that you're an angel investor, you're focused on investing on the continent. And in fact, before you talk about your thoughts about valuation, it would be great to introduce yourself so people know the portfolio companies that you have and the companies you've invested in, so that when you talk about valuation, they understand where it's coming from. Over to you, Isaac.
Sure. I've invested in just over 30 companies now on the continent. And they're across sectors, and most of them are pre-seed. The couple that I've gotten to the seed stage, and my very first angel investment was actually in the US, in New York-based fintech / prop tech company started by a Nigerian who's in the diaspora. So my investment thesis is more around investing in African or African diaspora founders, primarily because, and from that community, I feel like it's easy to get connectivity and to be close to the problems that are being solved using technology and support the vision. My take on valuation is, and so on the intellectual side, yes, like I study mathematical finance. I have an appreciation for like valuation methodologies and like all of the assumptions and stuff that goes into it. But my very, very personal take on valuation as an investor is that, valuation is like what someone else is willing to pay for something and what you're willing to part with it for, right? Like, so, you could do all the analytics and come up with like a number X, right? And somebody else says like, well, I'm not going to pay X for that. I'm going to pay, like 30% less or 50% less, like for this and this reason, right? Like, if you're comfortable, like giving your security away for that level, well, then that's quote unquote fair value. And that's the reason why public stocks, of course, like, the market prices move up and down as people digest information and get an appreciation for it. So my view is, there should be a baseline for, like innovation and ideas, right? So I typically think like if someone has a good idea, even if it's just in the MVP stage, at the minimum, right? Like if the idea is viable and makes sense, it should be in the, 1.5 to 2 or $2.5 million range. Now, of course, I understand why most people would compare that and say, well, if you convert that to Naira, that is like $1 billion plus Naira, and you're telling me like this kid that is still in school came up with an idea, and the idea is all of a sudden what's $1 billion Naira? That doesn't make sense. So I try to think of it as like in comparison with what's happening elsewhere, right? Like if that person got into an accelerator, what would an accelerator pay for it, right? And there's a baseline that YC would pay and Techstars and the rest would pay. And even the quote unquote like the cheap accelerators in terms of like valuation, they will still value the person at like $1 million or more at the idea stage. And that's my view.
Thank you for sharing that. Francis, you already given us intro. They are going to cause trouble. What are your thoughts?
Yeah, no, so like from a valuation standpoint, I think there are different perspectives to take. The market has evolved 3 to 5 years ago. I'm sure like on the call, I see some founders who I know who were building companies 5 years ago. And I know that, you know, some of the angriest people in the ecosystem or the continent today will be a founder who tried to build a company 5 to 7 years ago, who gave away 30% of his company for less than $500,000. And nowadays, they're seeing some young dude, you know, raise $500,000 for maybe 2 or 3% of their company, right? So the ecosystem has definitely evolved. I think the challenge with valuation is that people don't look at it from the different angles. Now, the thing about valuation is that it plays out in different ways. Beyond the founders valuing their company, which means that, you know, the founders don't get diluted, and when they eventually exit from the company, they can make substantial money for both themselves and the shareholders. I find that often founders also don't understand the reason why VCs are also strict on valuation, right? And the way I like to think about it, just to get the conversation started, is a key stakeholder in this whole conversation that people don't talk about. People provide money to founders, and these are limited partners in funds across the world, right? Now, these limited partners give money to VCs and expect a return from those VCs. And in many instances, the way funds are structured is funds are structured across a 10-year period. So it means that for a VC to be able to give 2 times or 3 times of the money back to their investor, they need to have significant growth in the companies that they invest in, right? And with most companies, failing and not reaching certain exit multiples, it means that a VC has to be conscious of the valuation at which they are entering. Because if everybody was giving money at a high multiple, if everybody was investing in companies at 50 million, those VCs will not make money, because when the company eventually sells, or when those shares are eventually sold, they will not be able to make money enough for their investors, who are the LPs. So I think that a conversation, like a key thing to also consider when thinking about valuation, and how it affects the dynamics across everybody involved, which are the investors and the startups, is also think about the expectations that limited partners have from VCs. Because if the VCs don't perform, it means that the VCs will not be able to raise follow-on funding. And if VCs don't raise follow-on funding, it means that, you know, startups will not be able to get follow-on funding as well, right? So that's, you know, just a fresh perspective that I'd like to get the conversation started with.
Thank you, Francis. Again, these conversations are very touchy in the sense that, yeah, VC has LPs, but then there's a reality of the macroeconomics, right? As a founder in today's technology-driven world, I have access to information and I can benchmark across other ecosystems. I can see what's happening in Silicon Valley, just because obviously internet is now ubiquitous. We've seen international players coming into our market, and we've seen our founders getting into programs across the world, Europe, North America, and in some cases as far as Israel, right? And so they begin to benchmark. It plays there's a lot of information available to them, but then there's still the macro, would I say, effect, or the macros that you need to take into perspective here on the continent. How would you say as a VC that, the macros have effect, or the extent to which macros have effect on valuation today? What has been your experience?
You know, should I go first, Victor?
Yes, please. Yes, please.
Okay, cool. So it's interesting that you say that, because the market today is a founder's market. And what that essentially means is, because there's a lot of capital available. Back in the day, the VCs would go do DCF and say, oh, this is the valuation I want to invest at. and there'll be a negotiation. But nowadays, the founders tell you we're raising a $1 million round at a $10 million valuation on a safe. The best you get is if you have connections and you can bring something to the table. Maybe they'll give you a discount and give you at 8 million, while they give other people at 10 million, right? I think the very fact that there's a lot of capital, like you said, has made it a lot harder for VCs particularly, from a standpoint of being able to negotiate on valuation. What we are seeing a lot is for VCs is usually a case of if the company is out of your valuation range, you're just going to pass on the deal because there's nothing you can do to bring down the valuation because, like Isaac said, it's about what someone else is willing to pay for this, right? So if there's someone willing to, and in many cases, they're not just willing to pay for it, they are giving them money already. So if someone is raising 1 million and they've collected 800K from someone at $10 million valuation, there's nothing you can do. There's no valuation model you can do that will affect it. It's the 10 million that you have. So it's either you take it or you don't take it, right? So that's one angle. The other angle, like you mentioned, from a macroeconomic standpoint, which is essentially the valuations that we are seeing, do they match with the opportunity that is, the reality of the economic opportunity on the ground and the continent? That's a different conversation. It's a different conversation that time would have to show. I say this, that in the next 3 to 5 years, the same way we're having a lot of capital coming into the ecosystem today, the next 3 to 5 years, we'll see a lot of companies that are raising rounds now and announcing on TechCrunch. We'll see a lot of them, unfortunately, and sometimes might not be to their own faults. Unfortunately, they will go out of business while some other people would stay in business, because very often I will see companies valued at $20 million and their monthly revenue is $5,000, right? It's a simple conversation of, if you are not able to raise your next round and you're making $5,000 in revenue today, and your monthly burn is somewhere around the $100,000, it's unsustainable, because if you're not able to keep the hype going, you would not be able to get in future capital. So I think time would tell if the opportunity, the addressable market that everybody's saying on decks nowadays. Before, it used to be $100 million addressable market, $150 million addressable market. Nowadays, it's $3 billion addressable market, $5 billion addressable market. No wala. Addressable market means people will pay you for that thing. So what time will tell now is if we would actually see the revenues. I think that's the key question. The question is, in the midterm, would we see revenues match up with valuations, right? That's the way I think about it.
Thanks a lot, Francis. And just off the back of what you've said, would we see revenues eventually converge with valuation? I'm going to ask Francis and Isaac this question, just from his experience, because of where the stage he plays in, very early stage, pre-seed, seed stage. What are the growth drivers you look out for every time you look at a company as early as they are in those stages? What are the things that you kind of position for and agree to pay such lush valuation at the time of your investment?
Yeah, great question. And if I may, I would use an example, but I'll try not to mention the company's name, so I'm not advertising them necessarily. But there was a SaaS player, that startup that I was looking at last year. So probably like 9 months or so ago. Revenue was relatively very small, right? Like in the 5 to 6K per month range. That's he was talking about. This was their first raise, and they were raising at 5 million. They were raising 500K, 10% equity. And most folks said, well, for first time folks raising, pre-seed, it should be in the 2 million range. And probably that was like the range that I had in my mind too, in terms of like, okay, this is what an accelerator would pay, and why should I pay more than an accelerator for something that's not joined an accelerator? But in chatting more with the founder and their plans that they laid out, and realizing that they have a patented solution, I essentially had to make a bet to say, like, I think that these guys are going to get, based in this accelerator, not necessarily like the name brand ones, but a corporate backed accelerator that gives them access to, proof of concept and pilots that would essentially bring their revenues to the millions of dollars in as quickly as 12 to 18 months, right? And saying, oh, okay, yes, I think 5 may be on the high side, but if they can get into this accelerator in the next 3 months and complete the integration and they get into this app store, well, it's game changing, right? And so I don't want to miss out on that opportunity, right? And yes, I paid at the 5 million to get into that name. And by the way, they did get into the accelerator that we were hoping that they get into. They did their integration and they're doing an extension around the bridge at 3x what we invested just 8 months ago, right? So I think some of the calculus has to be, how quickly can you ramp up? And it's not as easy as, to his point and Sani's point, just saying like, oh, this is the addressable market. But like, what are the tangible milestones that you'd hit in the next 3 months, 6 months, 12 months that would get you to the next level in the curve, and would prove that, okay, this is like the next level of valuation you'd get to.
So I hear you, tangible milestones, and a lot of investors are consistently asking themselves that and looking for, okay, if I come in at this stage, whether I'm coming in at pre-seed, whether I'm coming in at seed, what are the tangible milestones? What are the things I think this company needs to do to get to the next level, whatever the next level is? Oftentimes, it's not even very clear in our mind what it is. Obviously, because we have to do an investment memo and pretend that we have the full view, we'll put things down. But in terms of specifics, and just from your experience across these 30 companies, what are the specific milestones you want your pre-seed or seed companies to achieve for you to be comfortable with the growth that you're seeing?
Yeah, look, that's a fair one. I think product market fit is like different for like different companies, like as you view them. For me, I tell you, like, yes, I would explain more using this particular one. The company was checking technology. It's a authentication platform. For me, the solution was good, but if you don't get it into an SAP app store where large corporates can then subscribe to the service, well, then you're not going to tap into any market, right? It's just you going to the Coca-Cola and the rest and saying like, oh, come use my solution. And they're going to say, oh, no, we have like an enterprise, management solution. So we're not going to like pay someone else to, do this thing for us, except if you're already in that store. And so zero integration efforts. And it's basically just saying like, oh, I go to the app store and like download this new solution and I'm paying for it. Like it's like, like at the point of your manufacture. So it's already embedded into your whole ecosystem. So for me, that was like a milestone for them, right? Another one I would sort of mention is, like a one-click checkout solution like our pass, right? Like, a milestone would be, yes, you have this idea, and I invested in the idea stage, and you have this idea, and I invested that one in the idea stage because like I was familiar with like the frictionless checkout solution revolution here in the US, right? Like I'm seeing the likes of Fast and Bolt and Skipify, right? Like changing the face of e-commerce and saying like, well, this is the first of its kind in Africa. I don't know if this guy can actually do this thing to work, but if it works, then we're in for it, right? So I'm like, well, I'm willing to throw some capital into like seeing if this guy can do this thing to work. And so the first milestone is like, we'll actually build something functional that someone can use and we'll see. And now they've moved past the stage of like building it to work. Like it's already live, it works, they already have like merchants. And the next milestone is, well, how quickly can you get it to other countries? And it's like partnerships. Like, can we get like a partnership with Shopify or Paystack or whatever? Any of those partnerships like takes it 5x, 10x, like more. So for me, each company has like, when I look at each company, I look at like certain things. They say like, oh, this for me would be like a Cambrian moment for this company. It's a game changing moment in terms of like their J-core growth.
Thanks, Isaac, for that. Very interesting to hear. So for some companies, it's product market fit. For some companies, it's increasing the number of customers, reducing concentration risk, depending on the point at which you're getting. So research has shown us, right, on just from the median valuation in the US and in the Europe, there's a huge gap, right? So based on the numbers and normalized numbers for 2021, right, you see median numbers for valuation at about 68 million in the US, and very low, about double digits, low double digits in Europe, right? What do you think is driving that number? Again, from a tech ecosystem perspective, you have your office in the US. Is it the macros that are driving it? Is it just a function of developed ecosystem? I know your focus is in Africa, but oftentimes we see startups looking at these numbers and saying, okay, it's low in Europe, I'll rather benchmark for the US. So what do you think will drive such? Is it just a bandwagon approach? Do you see your startups copying or trying to emulate? What has been your experience?
I think what is driving the difference is bias, simply put. And if you drill down that number, even in the same US, right, and you drill down by gender and say like male versus female CEO, you still see a huge gap in there. If you drill down by, like race, you see like Black founded versus not Black founded, you still see the gap, even in the same location. But ultimately it's about, well, if most of the capital is in Silicon Valley and most of the capital is from white males, then those that are in that circle that can access that capital would naturally get a premium, right, over those that maybe don't necessarily have like even if you check like say educational background, like Ivy League versus non-Ivy League, you still see like that bifurcation. Because ultimately, like if a pool of capital is like focused on like a particular set of founders, well then those founders will get paid off. And we're seeing that with the, I guess, like the top 4 countries within Africa right now, right? Like the same sort of like startup and like economics, if you will, in Kenya would probably command a different multiple than say in Tanzania or in Sudan, right? Like in Nigeria versus even Ghana, right? Like that's like right next door. And there's only so much you can like solve for that. I think that creates an arbitrage that, well, maybe would be an opportunity for some other people to come in and fill. For instance, for me, the focus on Black founders, whether in Africa or in African diaspora, is that one, I'm able to access some of those founders, and two, well, if they're underfunded, then hey, there's an opportunity for me to make outsized returns compared to just investing in, like non-Black founders. We'll see how that goes. So far, it's been good. So.
Thank you, Isaac. I think again, it makes sense with different regions. You always find, as I mentioned, investor concentration, investor preferences, and biases playing a role. But Francis, your fund has investments in Europe and US. What has been your experience, and do you think there is arbitrage opportunity there, and are you taking advantage of it?
To be honest, I wouldn't call it arbitrage opportunity. Outside of fintech and a few sectors, Europeans are known to be very bearish on valuations, right? I'll give you guys an example. So at our fund, for our companies that are Series A, Series B, we occasionally do SPVs where our investors, our LPs are able to invest in these companies. And the only people we ever hear complaining about valuations are the European investors, right? You say a company is worth 100 million, and an European investor will ask you why the company isn't worth 20 million, right? So I think continentally, because we do have a focus on investing in Europe as well, what we are saying is that general valuations and the approach to valuations generally in Europe is probably even more conservative than even in emerging markets. So you will see higher valuations in Latin America, higher valuations in Southeast Asia.
Hi, Francis. Oh, yeah, please. Hi, Francis, you're back. We can hear you.
Yes. Vic, what was the last thing you heard me say?
So we're talking about emerging markets and how valuation across European investors are a lot more.
Yeah, so European investors are known for being conservative. So for instance, we did an investment recently and the company was worth just £2 million, right? And that same company, I can tell you that if that same company was raising either in, not even outside of, it's outside of the US. If that company was raising in Africa or the company was raising in Latin America, that company would have been worth 10 million pounds or thereabout, right? So I think in Europe, when I speak with other VCs globally, we often tend to see that outside of fintech and a few sectors like sustainability in Europe, you see that most other sectors are valued very low compared to the global average, right? And interestingly, nowadays, the valuations in Africa and Latin America are actually very close to the valuations in the US companies, right? It's very easy. It's very common nowadays to see most companies in Africa, especially if they've closed an initial small round of funding, the average valuation you will see is $10 million, right? Which is quite high, right? But that's the average valuation you will see in the US as well, right?
Absolutely, I agree with you. And I was going to point this question to my colleague Rofem, right? Just based on the valuation trends we've seen internally. Francis has alluded to the fact that the European market or European investors conservative, American investors are a lot more bullish, especially when it comes to VC. And the African or emerging markets are beginning to toe in line. Several things. What have you seen just from the research we've done internally, the trend? Can you talk to us about the trend across board? And focus on perhaps the present value of growth opportunities that emerging markets have, again, in alignment with CAGR that we've seen in 5 years, that might drive why valuation in Africa or emerging markets are turning towards what we're seeing in the US. Any insight?
Right. Thanks, Victoria. So, very interesting points that both that Francis has brought up in terms of like the conservative nature of the Europeans and the Americans. One of the things I'd like to point out is tax structures in these countries. Also, like one of the reasons why an American VC is more likely to pay a high valuation for a startup, particularly because this carry is probably has a lower tax rate than what the Europeans pay for. But also, in terms of where we see, in terms of present value of opportunity, it shows that Africa is largely underserved, has largely not been covered by traditional, by the financial markets. And we've seen growth in the other emerging markets like Latin America and Asia. And we've seen that investors have observed this growth trends in similar markets to African economies and seen like certain fundamentals that have spurred growth in these continents and these markets, and are betting on Africa being the next hotbed. And you can see it, especially in the fintech space. We've seen how Nubank took off in Latin America, and now we're seeing a lot of money going to the likes of Kuda. And basically, everyone understands that the fundamentals that drove valuation for that particular niche or that particular sector is actually present in the African markets and in countries like Nigeria and South Africa, Egypt, and basically they're beginning to they're looking to capitalize on this good trend and not miss an opportunity. So you might see the investors who were not able to capitalize on the growth in, say, South America or South or Asia, look at the next growth market and say Africa is next frontier. So in terms of like the present value of opportunities, largely it's the fact that we've seen these factors play out in other markets similar to ours, and basically in the next few years, betting on investors are basically betting on the fact that Africa would eventually crystallize, or like we eventually achieve those certain milestones that LATAM and Asia have achieved. So from my perspective, that's like literally what's driving our emergence of the of African valuation towards Silicon Valley and Latin America.
Thank you, Rofem. Isaac, do you have any thoughts on this?
I think like the data couldn't be more right, and then speaks for itself. But the only thing I would still say is, I think we're still in the very first innings of it, right? Like even though Africa seems to have arrived and everything, has been said. I mean, just this year alone, right? Like about 100 unicorns have been created, like globally, and so 100 new private startups have achieved unicorn status. No new one yet in Africa, right? Like this year. And even if you talk about like all the money coming into Africa, quote and unquote, like all the money that came to African startups last year was only probably 1% of the global startup funding. To his point on crystallization, as the Paystack sale and like May 1 sale and partial exits that many people had in Flutterwave and Mandela is costing more, recycling cash into the ecosystem, but also attracting newer players, right? And so we're going to keep seeing more new cash coming as companies, either go public or get sold and create exit opportunities. And by the way, with more syndicates and more people getting involved, there's the possibility of like secondary transactions now starting, right? And those secondary transactions are going to increase people's sort of like trust and belief in it. There's nothing like cash in hand, right? Like, so if you put your money in a startup and you have to wait for 10 years, right? Like, as Francis said, like, I don't know, most people don't want to wait for 10 years to get like distributions and like their cash, right? Like, if the cycle starts going down to 3 to 5 years, then more people feel confident putting in money in there versus just looking at unrealized gains, right, based on valuations.
I think, again, it makes sense, but this is another trend that we're seeing. Everyone has the same view that it's emerging market. Africa is the new frontier. We've barely scratched the surface in terms of the amount of funding coming into the continent for technology. It doesn't even compare to what some of the VCs have as dry powder, right? And so there's still room for more investments. Now, the question that often plagues our minds is with where the macros are going, currency devaluation, increasing interest rates, conversations around inflation. Is there any perceived tightening? How would that affect valuation going forward? And would that mean some people will begin to see discounts to the valuation at which they've entered now that everything is rosy?
Happy to jump in. Yeah, Vic, can you hear me?
Yes, I can.
Okay, cool. This is a very interesting conversation because recently I've also been talking with a couple of friends around CCI as well, which interestingly a lot of founders do not know about, right? And I would help founders appreciate what that looks like, especially founders that are at the pre-seed stage. Let's say you're a company that you've been running, you were founded in 2018, right? And you've raised $1 million, seed round. Now in 2018, you had $100,000 worth of, let's say you had $100,000 worth of revenue, right? That would have been, somewhere around 200 million or so back then, or yeah, I think 200 million or 20 million. I'm not sure what the conversion is, right? Let's say you've hit 100% growth year on year for the past 4 years. So that means you've gone from 20 million to 40 million to 80 million, and now you're at 100 million, right? That's amazing growth, right? It means that at the very least, your valuation should have, gone at the same rate. But the truth is that when you're showing that to your investors, because your investors are not investing in Naira, they're investing in dollars, right? So it means that your 100 million that's supposed to be a 5x growth of what you had 4 years ago, when you convert it to what things look like today, you have exactly the same amount of revenue that you had 5 years ago in dollars, right? So you've grown 5x in the past 5 years, but your revenue is at the same point in dollars, right? And I think founders don't appreciate this enough. So it's really important to be conscious of that when it comes to thinking about valuation as well, because it means that, especially if currency devaluation continues to happen, because especially if a huge percentage of your revenue is coming from countries like Nigeria, where there's tendency for high inflation and currency devaluation, it means that your business will be growing at core, like you'll be making more money, but the value of that money is also reducing as well. So you're almost having to work twice as hard as a company in Southeast Asia or as a company in Latin America that you are benchmarking your revenue against, right? That's number one thing to be conscious of. Number two thing to be conscious of is that your investors are giving you your money in dollars. So it means that when they are getting their returns back, they expect that money to come back to them in dollars, not in Naira, right? And when you think about it, especially when you think about exit opportunities will probably be either someone acquiring you, or, even if you were to list on the Nigerian Stock Exchange or whatever it is, you also have to think about how you repatriate returns back to your investors as well, right? And all of these things have to be reflected in the valuation, because if the valuation does not take this into consideration, it means that the founders and the companies could potentially be shot in the leg down the line, right? So I think that that's very important to think of when it comes to macroeconomic situation. Obviously, the growth of but I also think that, going to the other side and being a devil's advocate for the founders, unlike many other places around the world, the industries and the solutions that founders in Africa are building are infrastructure businesses, right? So the business that Paystack has built for the fintech sector, the business that Flutterwave has built for the fintech sector, the business that companies like Team Apps have built for the offline fintech sector, and many companies like that. These are infrastructure companies that agencies and government organizations in other places have to build, right? So it also means that potentially, if all continues to go well, the underlying value of the infrastructure that startups are building today would be worth more in the African context versus other markets, right? But again, this is also a speculation, right? So it's just about, those are two sides of the coin, the way I look at it.
Okay, so thank you for giving us your view, Francis. I think that we have these conversations all the time. No one eventually knows where it will end. And the hope is that with the companies you put in money, just continues to value regardless of what the backers are. But I think just picking off on what you've said, founders here in Nigeria, for example, just picking Nigeria as one, I know recently interest rate in Ghana has gone to as much as 17%, right? And so if you're here in Africa and all you're dealing with this, it's a global phenomenon, but you're dealing with all of this. We've seen companies try to diversify and quickly expand to be able to diversify this risk and ensure that maybe being in a stable market as opposed to a volatile market like Nigeria, but there's huge growth opportunity. And again, quote unquote, addressable markets seems to be large enough. How would you balance that? And how does it reflect in valuation? So the more reach you have as a company, does that significantly, or does that equate into higher valuations? Or companies who have chosen to pick a market, focus on the market and drill down, how would this thinking impact valuation?
Oh no, like happy to jump in on this. In my opinion, it's definitely the thing to do. Everybody talks about it, something that I always make a joke that, a founder will come and raise a seed round and say, for our seed round, we're expanding to 3 countries. We're expanding to Ghana, South Africa, and Egypt. They come to their Series A, they say we're expanding to Ghana, South Africa, and Egypt. By Series B, where is the Ghana, South Africa, and Egypt that you've been shouting about for the past 2 rounds? Because it isn't as easy to expand, right? That's also the thing to be conscious of as well, especially when you're in highly regulated sectors like either health or fintech, or even like identity management, right? So that's something that founders have to be aware of. I definitely agree that a company who has operations in multiple countries and who is able to execute that strategy successfully is much better off. So founders should definitely that should definitely be a strategy, especially when you're getting to the point where you want to raise a Series A. You'd need to diversify away from Nigeria and away from countries where the valuation of the currency is very flexible, right? Yeah, that's the way I think about it, and that's what we are seeing across board as well. That especially at the Series A stage and at the Series B stage, where it actually starts to matter, companies that are diversified have a better chance. Like if you think about it, Paystack just got their Ghana license. This is Paystack. Paystack has been in this game since 2015, and Paystack just got their Ghana license. Yeah.
Thanks, Francis. Rofem, I'm going to throw this question to you as well. So just from a technical perspective, as you undertake valuation, right? I don't necessarily have to be our portfolio. What have you seen as a trend between companies that have quickly gone ahead to expand versus companies that have said we want to deep down, hunker down in a particular market and grow out our solutions and product offering? In terms of valuation, how significantly different have you seen valuations go or range?
Okay, I mean, from our perspective, I've seen investors looking paying a premium for companies that are focused on scale or can scale. Because when you think about it, certain products and certain services, due to like the size of our addressable market, not necessarily from the gross perspective, but say like from the purchasing power perspective, tends to become a discount for companies, particularly focusing in Nigeria. So, for example, you might say that our market is 150 million people, but then when you talk about poverty or purchasing power, basically your addressable market begins to shrink and diminish. And then what that means basically is that your growth is limited. And basically, like if you're protecting for future cash flows, there's cash flows aren't there basically. What we see on my own perspective to Africa treat Africa as a market. You can't just be exposed to Nigeria, because when you look at it from Nigeria, most times startups is largely focused on Lagos. So how do you treat like multiple African cities as different markets for one business? And you've seen that basically the companies that investors are pouring in more money into are those startups that are showing the potential, or showing the potential basically to scale across those multiple markets. Because basically what we all know the challenges of building in Nigeria is solely, yes, the market is large, but then how many customers can you really acquire in that particular market? And also when you look at it from a cost of capital perspective, so by the time you start look at equity risk premium, let's say in a country like Nigeria, and then compared to a more stable economy like South Africa or Egypt, so by the time you start expanding, if you're looking at it from a technical perspective as to as a DCF, going into more diversified markets tends to mean that your equity risk premium spread, and you can actually now basically diversify your risk for the portfolio. And also other markets might have cheaper cost of capital. So basically valuation or basically expansion as a strategy for getting greater valuation has that benefits, right? But then it depends on which market you're going to. And what we've seen from within the portfolio and outside is that companies who are positioned globally or across the continent tend to receive a premium on their valuation relative to countries, companies with single exposure to the Nigeria portfolio, for example. Yeah.
Thanks, Rofem. Yes, I saw a comment in chat. Egypt is not immune. Absolutely. I think with everything happening across the globe, the Russian-Ukraine crisis, we've seen inflation being a topic of issue, not just in the US, but also in Europe. At the moment, no one is immune, so to speak. We'll begin to see ripple effects in the coming months. But I guess the take, and it might also be a bias, people will typically look at startups who are positioned to go into cities that have a higher purchasing power, and cities that are more urban, and put a higher premium on them compared to startups focused on peri-urban areas. So case in point, I have a startup who is focused on Akure, Ondo, and then I have another startup who wants to be in Cairo, Alexandria, Kenya, Nairobi, Mombasa. Think about the hotbeds, Accra. I probably will not place the same valuation multiples on them. But again, we've come to understand that valuation is very subjective. Someone is willing to pay 100x multiple. I'm saying that increasingly, and I'm not sure. I get confused. I get like shell shocked every time I see such debts. People are willing to pay that type of multiples today. Now, the question that comes to mind is, as subjective as valuation is, Rofem, what are the methodologies you use internally to stay grounded? Just to ensure that we're not drinking the Kool-Aid in the ecosystem.
So in terms of valuation approaches, so one of the major challenges you get transitioning from, say, IB to venture capital is the fact that you can't just throw DCF at everything. With public companies or more mature companies, you basically are able to do a precedent, apply a metric from, say, a publicly listed company in your market or similar markets to an accounting metric, say revenue, EBITDA, or build up your cash flows, and you're able to run a DCF around it. And to be honest, in terms of valuation methods, these are approaches that have been worked on for over the years. So like the basic principles of corporate finance. And for some reason, technology seems to be different. Both businesses tend to be different. But in terms of how we look at valuation, like approach to valuation for in this space is basically like adopting the traditional methods that we've seen over the years. So precedent transaction method, whereby you're looking at what other investors have paid for a similar company, or you're looking at it from, so for more mature businesses, so say they are data state businesses, you're looking at it from a comparables perspective, so publicly listed companies in that particular vertical, how much are investors paying for that kind of company right now. And then obviously you can always do your DCF, so that you have a clear understanding of what the business model is and what the risks are in the business. But I guess for me, where I like to put a fine line in between the DCFs, which are typically cash flow driven, and then the public market multiples, which are largely subjective to what investors want. And unfortunately, for us, we have the venture capital method, which basically combines the projections, your expectations for the business, along with what you an exit multiple, what you think people should be able to pay for this business in 5 years, and able to now factor in your risk into that into the business. So you're basically able to plot out the cash flows of the business off of your understanding of the business plan, and you're able to combine the good things of a present transaction or what the companies are probably paying for it. And then you're also not able to factor in your own risk, because really as investors, our capital has risk attached to it, whether it's what we're paying back to our investors or what we see are the potential risk in doing business. So basically, there's a balance to all four methods. Then maybe for a SaaS business, you might be looking at a user-based valuation, how to use our lifetime values to be able to determine the actual value of the startup that we're looking to buy, or that's the startup that we currently have in our portfolio. So those are kind of the approaches that we use to keep ourselves balanced. But at the end of the day, it's a founders market. So that's what it is.
Absolutely. So we're on the 5 o'clock mark. I know there's still a lot more to talk about in terms of unpacking the mystery behind valuation. Thank you for providing color. Again, once it comes to the technical, it's always very, a lot of people don't spend so much time trying to understand. It's difficult, it might be complex, and so it's finding the lowest or the most frictionless point to get into a number. Francis, so what are your thoughts? Is the African tech ecosystem or the startup ecosystem fairly valued? I think he just dropped off. Rofem, is the African technology ecosystem, is it fairly valued or not? Your thoughts?
I think we're still in price discovery. I think we'll always find out at the next raise. So are more companies raising their Series B? Are they raising their, are they going further? Are they being acquired? So I think we're still in price discovery. It's a private market, so it's very opaque. Unless you have visibility on other transactions, it's hard for you to understand what the appropriate price is. But then again, it's good. I think there's, as long as you believe that there's still like room for large growth in our ecosystem, then I guess, yeah, it's what it is. It's appropriate, it's an fair value.
Thank you. Isaac, I know you're here. Unfortunately, I don't see you on my screen. Closing remarks, what do you think about valuation? Is it fairly valued? Will you continue to double down on your position at the numbers that we have seen in recent times? Is Isaac on the call?
Did I press switch dropped off?
Oh, okay, Francis. Okay, I think Francis has connectivity issues. But I think if we were to look at, just listen to everything that the panelists have said from the angel investing side, from the VC side, and generally from research-driven materials or contents that we have, it appears that we'll barely scratch the surface. We'll continue to see valuations in the short to medium term remain lush. We don't see it being depressed anytime soon. This is my view. I think Francis is back on. Let me get your last comments. We'll take this to an end. Francis?
Yeah, so essentially in terms of like, do I think valuations will come down?
No, your final comments. What do you, valuations you think are there at the moment?
I think founders, yeah, I think valuations will continue to go up as long as what's it called? Capital is available. The thing I would say is that something that is often overlooked nowadays is founders think they have to constantly raise. So everybody's on their race for do your pre-seed, do your seed, do your Series A, do your Series B. If you look across board, if you look at the average acquisition and exits, especially via the acquisition routes, the average acquisitions are usually between the $100 million to $500 million range. That's like the most common ones are usually between 20 million to 50 million. So it means that a lot of, especially when you think about it, based on the number of companies we're producing on the continent, the exits multiples and the exit price is going to be somewhere between 20 to 100 million in the nearest future, right? And founders have to be aware of that, because it means that if a company is going to get acquired for 20 million, and this is in 3 or 5 years, and the company is raising at 15 million, so the VC is only making 1.5% on that investment, right? And what I would say is that the good guys will get separated from the guys that are not so great, and we're seeing it happening. There's a lot of consolidation happening in the markets. Companies who raise Series A at 30 million, 40 million are being acquired for less, right? Companies are raising down rounds. Some companies are finding it hard to raise follow-on rounds, right? So depending on the sector that you're in, depending on what you're doing, if you can be responsible with valuation, you should definitely be responsible with valuation. At the end of the day, it's really about getting the capital that you need to be able to grow your business, right? That's all I have to say. Thank you all, everyone.
Thank you, Francis, for your thoughts. You're responsible with valuation, you're responsible with the raise. Get what you need. I think that's what I'm getting out of this. Isaac, any last thoughts on where valuation is?
Yeah, and thanks for having me. I'm back on. Sorry, I switched devices. Yeah, like I think valuations at a decent point, and sadly will continue to trend higher just because more attention and more capital is coming in. Although even with that, I would note that and I would acknowledge and recognize that a lot of founders are still struggling, primarily female founders or founders that are not like quote and unquote plugged into to people that are connected to accelerators, or founders that are not in accelerators, right? There's still like huge bifurcations across different lines in there. So folks should hang in there, keep building, and keep optimizing the cash that they raise. As Francis said, some folks get carried away and raise so much cash, high valuations. The market is not friendly to people like that over the long term, and we'll see more and more down rounds over the periods and more forced sales. So folks should continue to optimize cash and build for the long goal. Thanks for having me again.
Thank you, Isaac. And speaking to what Isaac has said, access is still a problem. I think the work we do at CcHUB is to ensure that founders have access. And so we're not investing in just one thematic area. We invest across several thematic areas. We also provide access to pre-incubation, incubation, and accelerator programs, which I know Francis used to lead at some point, seems like, that would allow you get the required resources to build your companies and scale it, and also have access to the required partnership that would allow you create the kind of value that you want for your company. And this is whether you're as a founder or an angel investor, we'll continue to do that. We continue to partner with angel investors like Isaac, like Francis, and other investors within the ecosystem to ensure that more and more founders can have access, great founders can have access to the required capital that they need to scale their businesses. So to learn more about our work, you can, the website will be dropped in the link. Feel free to follow the website and learn more about our work. I'll be dropping also in chat Francis' Medium page. He turns out to be the writer. And so you can see some of his work that he has put out. And also for Isaac, we'll confirm if it is open to talking with the founders who are on the group today. And we'll set up something so that interested founders can also engage with him. Thank you to the panelists. Thank you, Isaac. Thank you, Francis. Thank you, Rofem. It's been an interesting conversation. And thank you to all the audience. We've been very pleased to have you on board. We look forward to our next session where we talk about more intriguing conversations within the tech ecosystem. Do have an amazing evening. Thank you, everyone.
Thank you. Bye-bye.
Yes, well, bye, everyone.